Hello and welcome to another episode of the Federal Church Presents Better Than Bloomberg, covering the global financial collapse, especially in America. The worst in history. And today, equity markets in Asia and Europe look like they were down significantly. And in America, they had a little bit of the hopium. Looks like PPT was in action printing money to make everybody poor. Add a little bit more fuel to the inflation fire. But aside from that, it's just as expected. They'll have a little bit of hopium, have a little bit of cheerleading on the Bergs and CNBCs and Fox businesses, adding to the volatility on the way down to zero. I guess I should put that on the camera there. The headlines were reading, oh look, there's some sort of bank bailout and now there's stability in the system. No, there's not. There's still rampant insolvency. And this was as the headline on Bloomberg was that First Republic was tanking, I think at its lowest share price ever. So I guess we'll see that in a little bit. Zero Hedge had a note there. But it's almost comical at this point. The amount of the U.S. bank run was on a good note here by Zero Hedge. Still haven't bothered to sign up for the premium there, which I guess I should do at some point. But headline rating: record $304 billion in weekly FHLB debt issuance hints at staggering size of the U.S. bank run. You have to think about that. $304 billion weekly. So it's been almost 2 weeks since the shocking overnight collapse of SVB, and yet amid growing speculation and demands for clarity on the size of the deposit flight from small banks, we still have no definitive quantified impact of the ongoing bank run. Again, not yet. But that's because, as we explained last week, the Fed's H8 statement, while providing a granular consolidated data for both small and large banks, is about a week late. Last Friday's latest edition covered the period for the week ending March 8th. The day it all started when Silicon Valley's bank run started. So again, this is an issue of liquidity. This is an issue of solvency. And nobody in their right mind will keep their deposits in an insolvent bank, which is what you're seeing there. And then there is another good one there from Zero Hedge. The U.S. studies how to guarantee all 18 trillion in U.S. bank deposits. Again, there's about 200 banks going under here, and opium's not going to keep them alive. But let's see here. After repeated laments by the likes of Bill Ackman, who most recently said, "I continue to believe that the best course of action is a temporary FDIC Gov deposit guarantee until an updated issuance regime is introduced." So again, that sounds nice, but how exactly do they guarantee all 18 trillion in U.S. bank deposits, which are mostly now in banks that, by convention, did the dipshit trade and are now insolvent? Here, and who just flip-flopped on his Fed must hike with shock and awe call from 2022 and is now urging for a Fed hiking pause. I wonder why. I mean, if you take a look at his positions, you'll figure out why. But in following a Bloomberg weekend report that U.S. mid-sized banks demanded a 2-year total deposit insurance scheme from the FDIC. Oh, which, by the way, this headline here pretty much sums up all these imbeciles' inability to count. Or reason, because I'm sure you can see it on the router vision, but the kind of shit class garbage I have around me, they're not the people with more than $250,000 in the bank. I'm pretty sure they're at least that much in debt. They're the people with negative net worths. So that's just pretty much the way it mostly is in America. So what do they care until they lose their shitty jobs, right? Will be in the billions. So, and The following Bloomberg weekend report that U.S. mid-sized banks demanded a 2-year total deposit insurance scheme from the FDIC and warned if it doesn't arrive, which it won't because they can't really write checks they can't cash. There may be lots more shotgun weddings or shotguns as a reference to the UBS Credit Suisse merger. And there's a lot of hopium there, in that bit, where congratulations, you finally had an insolvent bank, taken apart. And now what about all the other banks, especially in the Eurozone, especially in the pigs banks? That moments ago, Bloomberg reported that U.S. officials are studying ways they might temporarily expand FDIC coverage to all deposits. Just fucking laughing. A move sought by a coalition of banks arguing that it's needed to head off a potential financial crisis. See, that's the thing. It still won't change the fact that these banks the dirty line money changers are still telling people to drug the Reverend's food here. Which, by the way, we'll get some more of now. 1 second here. Oh, which, by the way, you didn't donate. I can care less if you get some quality video. Here we go. Guess our March 12th tweet was ahead of its time yet again. FDIC unveils new sign. FDIC insures up to infinity per depositor per FDIC insured bank. It's kind of where you're at now. And what that means for these shit class fucking scum. Inflation and poverty. They're not going to be the ones making the money off of this. Backed by the full faith and credit of the United States government. The Bloomberg report explains that Treasury Department staff are reviewing whether federal regulators have enough emergency authority to temporarily insure deposits greater than the current $250,000 cap on most accounts, without formal consent from a deeply divided Congress. It goes on to note that authorities don't yet view such a move as necessary, especially after regulators took steps this month to help banks keep up with any demands for withdrawals, which is an important caveat and is the same one that hawks are using to justify why a Fed pause would be self-defeating. Why is the Fed blowing up their last bit of inflation-fighting credibility? What do they know that we don't? Well, pretty sure they know. A lot of banks are insolvent. The same question can be applied to the Treasury. What does the Treasury know that we don't? Most likely nothing. After all, bank crises are nonlinear. It starts gradually, then suddenly. But as Bloomberg notes, still they are developing a strategy out of due diligence in case the situation worsens. Definitely going to worsen. We will use the tools we have to support community banks. White House spokesman Michael Kuku, said without directly addressing whether the measure is being studied. Since our administration and the regulators took decisive action last weekend, we have seen deposits stabilize at regional banks throughout the country, and in some cases, outflows have modestly reversed. Still, the report notes, the behind-the-scenes deliberations show there are concerns in Washington's corridors of power, as mid-sized banks call for broader government intervention after 3 lenders collapsed this month when uninsured depositors pulled their money. And as a fourth part,
think you're
Wait
good.
a minute. There we go. And call for broader government intervention after 3 lenders collapsed this month when uninsured depositors pulled their money, and as a 4th firm strives to avoid a similar fate. And then shares of that one, First Republic, which tumbled an additional 47% on Monday, as industry leaders tried to find a way to bolster the company's finances. And again, none of this hopium that they try to spew will ever materialize, because these aren't investment banks like Credit Suisse. These are simple depository institutions, and they have no businesses to sell. They have no assets to sell. All they were supposed to do was take deposits and loan out money, either in the form of loans to their customers or loans to the government in the forms of treasuries, toiletries, or in the form of buying up mortgage securities, which they all screwed up. So there's none of these are going to survive it. None of them should, because they were managed by screw-ups, and they should be allowed to fail. So, okay, that's the theory. What about the practice? After all, as regular readers know, there are 18 trillion in total deposits. 18 trillion. All of which have to be insured. Take a look here. The entire GDP, the gross domestic product, the economic output of the United States in 2021 was 23.32 trillion. So now they expect the Fed, who is bankrupt themselves, insolvent themselves, to ensure, well, I guess, the bail-in administration corporation, but the Fed did, to ensure 18 trillion in total deposits, which is not going to happen unless they print a ton of money and make all of the poor people poor. And just 125 billion in the FDIC's the Bail-in Administration Corporation's Deposit Insurance Fund, which makes an outright guarantee of all deposits just a small mathematical impossibility. Yeah, and this is what I mean, where we have a bunch of dipshits too, as far as I see too. I think they're smart, who cannot count, or reason for that matter. Well, there's always money printing. According to Bloomberg's team, one legal framework under discussion for expanding FDIC insurance would use the Treasury Department's authority to take emergency action and lean on the Exchange Stabilization Fund. The same magical Exchange Stabilization Fund, which the Treasury is already using to backstop its latest bank bailout facility, Bank Term Funding Program. And here too is a small problem. That ESF pot of money is used to buy or sell currencies and to provide financing to foreign governments. An even bigger problem. The ESF only has 25 billion currently in it as part of buy the fucking pivot backstop. But it has to do, as it's the only pot of money under the full authority of Janet Yellen, with other financing and spending under the jurisdiction of Congress. Any mechanism using the ESF as a bailout mechanism uses the cash from the fund as a first loss equity tranche, to which the Fed then applies leverage. Lots of leverage. Because if authorities plan on backstopping the 18 trillion in total U.S. deposits, the Fed will need to cover the difference of some 18 trillion. Unless Congress reaches a bipartisan deal to infuse more capital in the ESF. Same way the ESF was expanded to 500 billion during the COVID crisis. to, again, more than 3/4 of the GDP of the United States. Fucking or idiotic, I mean. Meanwhile, in keeping with their tradition of saying the polar opposite of what it is doing, a Treasury spokeswoman said in a statement that due to decisive recent actions, the situation has stabilized. Deposit flows are improving and Americans can have confidence in the safety of their deposits. Which again is absurd when the banks are insolvent. Which of course explains why First Republic is about to join the collapse contagion, why Treasury is planning a full deposit backstop. And it's not contagion in the sense that banks are taking down other banks yet. Until the derivatives start imploding. But it's a collapse simultaneously because they all did the same dipshit trade. Finally, such a program will likely have to also be the result of an executive order, since it has little hope of passing in Congress, where members of both the left and right will be vehemently against it. Especially because it makes everybody fucking poor. Because printing, 3/4 of the GDP of the United States is going to guarantee to pour fuel on that fire. Any universal guarantee on all bank deposits, whether implicit or explicit, enshrines a dangerous precedent that simply encourages future irresponsible behavior to be paid for by those not involved who followed the rules. The House Freedom Caucus said in a statement, and we are confident most of the progressive wing will not be too excited about bailing out billionaires and corporations with orders of magnitude more in the bank than the FDIC limit. And again, for most of the shit-class Americans who don't have any money in the fucking bank, that's not going to be of concern for them. And it only will be when it's their jobs that are gone because of it. If they even have a job anymore. That's not some underemployed crap too, by the way. And, well, I guess for them it's not really underemployment because, they're qualified to be in sweatshops. As the Chicago Fed wrote in a paper in 1986, after the deposit runs at Penn Square National Bank and Continental Illinois Bank, uninsured deposits are a source of market discipline for banks. Herbert Baer and Elijah Brewer go further, warning that doing away with insured deposits, i.e. by insuring every deposit as being considered currently, would actually increase risk in the banking system. Oh shit. So while such proposals might reduce the likelihood of bank runs, they would at the same time reduce banks' incentive to control risk. Which is an absurd statement in and of itself. Because knowing full well that the Fed or FDIC or Treasury or whatever bullshit, program or institution, knowing full well that they're already insolvent, nobody in their right mind would think that there would be no risk putting your money in an insolvent bank when, something like those funds have only a few $1 billion in it. Supposedly that's going to cover $18 trillion, which is more than 3/4 of the GDP of the United States. Again, these are just people either too stupid to count or reason. Will U.S. bank regulators learn from the mistakes of the past? Probably not. But again, this isn't the bank regulators' fault. This is the management of the bank being dipshits. Because no CFO has an excuse for not making sure they didn't do the dipshit trade. So, again, there's a lot of the hopium going on, crying, this or that. Oh, there's stability, there's backstopping, there's reassurance. No, there's not. There isn't. I mean, they could tell you whatever bullshit you want, but just like in 2008 when they did the same, it's all going to zero. Again, don't forget to donate. Just don't forget why you're in this mess in the first place. Don't forget why you're in this mess to begin with. You didn't donate. God, very angry at you. Very angry. So, pay your tithes too. Bitcoin wallet down below in the description there.